Okay. Hi, this is James Eng with Old Capital, and I am here with Jeremy Roll. Jeremy, thanks for coming on today. And we've just got a couple questions for you. And so, just to get started, um, I like to ask sort of a different type of intro question. So, I guess when your parents ask you what you do, how do you explain it to them?
That's a good question. And by the way, thank you very much for having me on. I really, really appreciate it.
Yeah.
Um, oh boy. Well, my parents are a whole different story in that they'd still have trouble understanding, I think. But um, I like to tell people that I'm a full-time passive cash flow investor. In that I try to find opportunities that provide cash flow, and I actually live off the cash flow. I got out of the corporate world back in 2007 from the cash flow, so I'm kind of a full-time passive cash flow investor. I'm passive in the deals I invest in, but I do it full time in terms of trying to find opportunities and find new ones.
So why, I guess take me back to maybe college. It's not like they have you can get a major in passive cash flow investor, right? So take me back to maybe start maybe coming out of school. What did you do before this? And a little bit of that background. And then maybe why, after doing that, you decided to move into this field.
Yeah, great question. And you make a good point. There really isn't as a formal education or anything like that. So I'm from Montreal, Canada. I was in undergrad in Montreal, a school called McGill, which some of you may or may not have heard of.
Okay.
And I did an undergrad degree in Bachelor of Commerce, which is like a management degree for business. And so one of the great things that was helpful for me is with that focus is that I'm a numbers guy and working on spreadsheets, et cetera. Really I got refined in how to look at things, and a lot of that undergrad studying really helped for that. I then worked for a large retail systems company in Canada, the largest privately owned retail systems company. We basically sold cash register systems to very large chains in the US, actually. It's a lot of large chains everybody here has heard of. And then worked for a startup that was a media and telecommunications company owned by the Canadian government for about a year. Then I moved on to Philadelphia, actually. And I did MBA over at the Wharton School or University of Pennsylvania for 2 years, graduated in 2000, and then moved out to LA. And I'm getting to the investing part, don't worry. And then I worked for about a year and a half at a startup that was a combination. It was like auto slash media startup. I'm a car guy, so that was a really good fit. And then I started working at that point, I forgot actually, when I did my MBA, I actually did an MBA internship over at General Motors headquarters on the Corvette Camaro brand marketing team at Renaissance Center in Detroit, for anyone who's familiar with that, the large headquarters of GM. And then I started working for Disney in brand marketing on DVD and VHS products in 2002. And that's in Burbank in LA at their headquarters.
You're
So
showing your age. You're showing your age saying DVDs.
yes, I'm getting up there for sure. And trust me when I tell you, I've got more than enough DVDs sitting in some pile here in my house. So now, where the investing part kicks in for me is that I was always intrigued with investing. I couldn't tell you why. I actually follow the stock market. I used to make like fake portfolios on Yahoo Finance, and I used to follow. In fact, at work, I'd look at CNBC throughout the day, see what's going on. I can't tell you why. And so what happened with me is that I was, like a lot of other people in large companies, workers, I was investing in my 401k through Fidelity Disney retirement plan, and the dot-com crash happened. And so that's in 2001. I'm a really low risk, low and steady guy. And to watch the volatility of the stock market going up or down 30% a year was not for me, but was more interesting actually. And the thing that really bothered me the most was the lack of predictability of the stock market. The lack of predictability of where my retirement account would be in 10, 20, or 30 years. And so I got fed up with the stock market after the dot-com crash for those two reasons. And what really motivated me was that lack of predictability, to try and find something that's more predictable. And so I looked at different ways to invest. Interestingly, my grandfather and my father had background in real estate. My grandfather was a real estate investor for decades. I never learned the business from him, unfortunately, but he was a real estate investor for literally decades in Montreal. My father was at some point a commercial real estate broker. I didn't learn anything from him either about it, unfortunately, but they were both in there. And so I started looking at different ways to invest, and I started looking at real estate, and I landed on passive for myself at the time because I was just working really, really hard at Disney. I mean, I was making calls in the elevator on my phone that they weren't even paying for and all kinds of stuff. And so I didn't have time to do anything active. So I started on the passive path. And what I concluded for myself was that for predictability, I had to look at stabilized cash flowing opportunities, right? So the idea would be that if something's, let's say I'm looking at a 200-unit apartment building and it's 100% occupied in a strong demand area that's forecasted to continue to be strong demand, then I get to go to sleep tonight, wake up tomorrow, and not much has changed. And if one tenant moves out, there's 199 tenants left. My cash flow is still fairly predictable. Nothing's perfectly predictable, of course, but it has that degree of predictability. So I started rotating my money out of stocks and bonds into commercial real estate opportunities, and I kind of started going down the passive path, and that's how it started, and that's how I continued. So for me, it was truly like a dot-com crash. How do I get into more predictability? And ended up on this passive path.
So this is, I guess, was your first investment sort of 2002, 2003? Is that sort of the time frame?
Yeah, January, February 2002. And interestingly, my first investments were not in the US. So okay. I got very lucky because I had lifelong friends in my family I lived a couple blocks away from that I knew since I was 4 or 5 years old, who had been syndicating opportunities for decades at that point already. Okay. 2 generations. And the biggest concern I had in the US when I was starting is my network in the US was pretty small. My network in LA was pretty small for 2 years. And I didn't know who to trust. Because, the one thing about when you invest passively, as you know, James, is who you're making the bet on is the most important thing, then followed by the property, at least in my opinion. And I had a very big problem I didn't know who I was making a bet on here at all. I didn't know no referrals. It was brand new to me. So, no one at work that I knew was investing like this. And so I started doing a lot of networking, but the key for me was that I actually was able to start investing with these lifelong friends in my family who were investing in commercial real estate. They were syndicating commercial real estate in Canada. And so I started going down the path by doing a few deals with them. I was able to fly out to properties with them. They were really walking me through the ins and outs of things. And then I also started to go to a lot of local networking events here in LA. I averaged about twice a week because at that point I was significantly younger, didn't have kids. Did have DVDs though.
Had a lot of DVDs. Yeah.
And some VHS still. And so I had the ability to go out there and really network a lot. This is pre-internet where you didn't have access to stuff. So you had to get out there and
you had to go to events actually to meet people. It's crazy.
Had to go to events, just like conferences, and so I did a ton of networking and eventually learned all this through what I call opportunity exposure, combined with listening to a lot of presentations and speakers at a lot of events and conferences.
So let's go back to maybe you can pick 1 or 2 of your first. I mean, now it becomes so easy because you're in 70, 80, 90 transactions. But maybe that first 2 years, talk through maybe some of those transactions. Were they office, industrial, retail, multifamily? Like what property types were they? And then what sort of returns were you expecting on those deals that got you comfortable?
Yeah, great question. So I'm actually embarrassed to say I can't remember the exact first deal I did. I remember when it was, but I don't remember which one it was. I'm going to have to ask them. Because I've actually now invested in over 20 deals with that one syndicator. So it's just all together. But I will say that they were focused mostly on office and retail. That was their focus. And so that's what I learned first, because that's what I had access to as far as like the lowest risk in terms of who I'm making a bet on. And, interestingly enough, office and retail are not my focus now. I've actually come to focus on other asset classes for more predictability than those, which is kind of interesting, but that's where I started. The returns at that time were very similar to the US, very reasonable cap rates. Figure it'd be an 8 to 9, 9.5 cap, with normal leverage, let's say 70% LTV. They were very conservative investors. They were cash flow focused, stabilized core plus assets. And you figure I was targeting a year 1 cash flow of 9% net to investors or better projected, a 10-year average cash on cash return of maybe 11% or better projected net to investors on average, and a total ROI of, maybe 15 to 18% annualized. But really, in the end of the day, that was all driven by the cap rate, because these were buildings that were 80 to 100% occupied and stabilized with not, optionally some value add upside, but not mandatory. So that's a profile I started with. And it fit my personality really well because I'm a low risk guy. And so it fit the predictability and the low risk really well for me.
How would you say those returns compared to now? Is that your criteria back then compared to now? How has that changed?
It's funny because my criteria back then in that cycle, so To take a step back, so I invested between '02 and '05 in a whole bunch of opportunities, mostly with them. And then in '05, I actually started to get really worried about where the market was in terms of cap rates, housing prices, et cetera. And I sat mostly on the sidelines for several years. Now, when I say that there's always unique opportunities, I'm always making investments, but the mentality was that I was sitting on the sidelines between '05 and '08. Now, that cycle ended, and then when everything reset and cap rates reset, they reset to about the same levels in terms of like a Class B asset with those types of returns I was able to get before. So it was actually similar targets to what I had back then that I had throughout this current cycle. The challenge is that today, I personally believe we're at the end of a cycle. I think it's a very dangerous time to invest because I think cap rates are very low and cyclically, and I cannot find opportunities except for very unique ones that match my criteria. So the criteria I just mentioned before that I was looking at, actually I use the exact same criteria because I was able to with the cap rates that reset into this entire cycle, and I still hold to those. That's actually what keeps me out of trouble, in my opinion. So I'm waiting for a market downturn and cap rate reset to see what my next criteria is going to be for the next cycle, which I suspect with interest rates having come down so much over time structurally, I probably won't be able to get those levels of cash flow next time. I don't think cap rates are going to get that high, so I'm going to have to see where things go and then reassess.
Okay, so just so I understand the criteria, it's sort of year one, year two, 9% cash on cash to investors, or is that year one?
Year one would be 9%.
9%.
Year two
okay.
would most likely end up in either double digits or very like 9.7, that type of thing, rounded. Okay. And then a 10-year average cash on cash returns of 11% or better on average net to investors. You got to remember, I live off the cash flow now. One thing I didn't mention at the beginning is that I got out of the corp world in '07 after rotating all my money from stocks and bonds into cash flow of all different types. And I got out of the corp world in '07. And so I live off the cash flow now. And so whenever I look at a deal for my own need and my own profile, I focus mostly on the cash flow. The returns and the ROI and the rest is all icing on the cake. It's just the cash flow that I depend on to come to me to live off of is what I really focus on.
Going back to, because a lot of people have this, like, what made you comfortable in 2007 to leave? I guess, were you still at Disney in 2007?
No, so in 2006, I worked for Disney between '02 and '06, the beginning of '06, when I finally didn't have a foreign visa anymore and I actually had a green card through marriage. I actually was able to then choose where I wanted to work a little more easily.
Sure.
I ended up working for Toyota headquarters, in fact, because I'm a car guy. And so I worked at Toyota headquarters between the beginning of '06 and mid '07. And I left the corporate world. So let me just say this. There's a lot of people I talk to who have a very distinct plan, 5 or 10-year plan of investing X amount per year in passive cash flow, generating Y amount of cash flow and getting out of the corporate world within 5-10 years. And it's a very specific plan, and I love it. And I love people getting out of the corporate world because it just changes everything, and I've been through it, and I like watching that happen.
Sure.
I did not do that. Okay. I did not do that. I actually wanted to have the predictability for my retirement account and the paycheck, W-2. So I did not go down the path to get out of the corporate world. I left the corporate world in '07 strictly because I had a last strong moment with my manager in a new role in the new division of Toyota that I went into. That kind of was the moment for me. And since I had the cash flow built up to be able to live off of, I actually took the risk of leaving. I said, I'm going to give myself 2 years and see what happens. I actually was convinced we were having a downturn at that point around '08. Yeah. And long story short, though, because I had the passive cash flow that was on the lower risk side, more diversified, more predictable, I really wasn't too worried about it. I had enough sources. I had enough coverage in terms of, the ratio between cost of living and cash flow was over 1. And, I don't remember exactly what it was, but it was at least 1.5 or I wouldn't have done it. It was probably closer to 2. I also had a much lower cost of living back then. I was younger, didn't have kids, etc. But I left the corporate world. And funny enough, I left the corporate world in June of '07. My wife went on maternity leave. She was a teacher for the LA Unified School District. She went on maternity leave. We had our first child in October of that year in '07.
Wow. And
we didn't go back. Okay. And I was anticipating a downturn, and I still left the corporate world throughout all this. And she left her job throughout all this because we had that buffer of cash flow built up that I was pretty the people who don't know me out there, I'm highly conservative. So, I was highly diversified at that point and really comfortable with what was coming in.
So, yeah, I mean, a lot of times there's not a good time, right? So you can never predict when stuff is going to happen. And so, I mean, I guess one thing that's unique is now that you've been doing this like a lot of people will invest in deals as a passive, keep their W-2 job, and just keep cranking along. I guess like throughout the downturn, you've been investing, but then how else do you become, I like to call it more like an active passive? Like what other things do you do? Because like I'm passive in a lot of opportunities, and like we were just talking about this, like me selling a single family house, my personal residence, has taken more work than all my passive deals combined. So what else do you do as a passive? Because right now, I mean, essentially underwriting deals, deciding on, all right, I'm putting 100,000 in this deal and wiring the money. That doesn't take that much time after you've done it this many times for yourself. So,
Right.
like what else, I guess, how else are you involved in these different opportunities?
Yeah, absolutely. So there's a few different things to consider for me that might be different than other people. First is that I take a hyper diversified approach because I'm just really low risk. And so I'm in over 70 LLCs right now, as you mentioned before. And that includes the fact that I've been over 25 sales in the last 2.5 years alone.
Wow.
And I've easily been in over 100 LLCs over time. And so as a hyper diversified approach, that's keeping me busy, full-time job to be able to be that diversified, because stuff sells, you have to reinvest it. Cash flow comes in, you got to reinvest it. So it's truly full-time that I do. And so that's kind of number one. My hyper diversification leads it to be it's a lot of work, but it also allows me to sleep really well at night. Okay. So I don't recommend it for most people, to be honest with you. And most people don't need to be in 70 opportunities, but I do it full time. And the more I find, the better off it is from my perspective. Right. Number two is that I actually co-founded something when I left the corporate world in 2007. It's an interesting story, actually. So I'd go to a lot of meetings around town, networking meetings, as I mentioned, probably about 2 weeks between 2002 and 2007.
Yep.
And some of them are great, and some of them are sales pitches, which are not so great. And so what I would do is, without knowing in advance, I'd actually take my work with me from the corporate world, bring it with me to go to that nighttime event. I'd sit in the back row, do work for 2 hours, and then at the end, I'd go network with people, and I would not pay attention to the sales pitch. Okay.
Yeah.
I went there purely for the networking, which most people did at the end. Well, the problem is that the first meeting I went to right after I left the corporate world, must have been the summer of 2007, I was sitting there in the sales pitch. I said, oh my God, I don't have work to do for 2 hours. I'm literally just sitting here listening to a sales pitch for 2 hours. Like, why am I wasting my time when I can run my own meetings?
Right.
And I can create meetings without any, like with their core foundations and no sales pitch.
Right.
So now that I was out of the corporate world, one of the first things I did was actually co-found a nonprofit called For Investors by Investors, or FIBI. Most of our meetings are in Southern California. And our core foundation is that there's no sales pitch. We're just hyper vigilant about it. And that took some time at the beginning, getting those meetings done. I actually managed 2-3 meetings a month myself. We grew it a little bit. And so that's become actually the largest series of public and non-institutional investor meetings in California. We have over 30,000 registered users now.
Wow.
We have multiple chapters throughout Southern California and a couple out of state, but not very many. So that's another piece. And then the third piece is that I actually started my own investor group all the way back in 2002 that continues to exist today. That's my secondary focus. My primary focus is my own investments, and I've done that purposely, and I've structured it to stay that way purposely. I don't have any staff with the investor group or whatnot, but I did actually form that, and that keeps me very busy. The greatest part about the investor group is all the networking with other investors, trading opportunities, trading information about syndicators. And so I spend my full day, full time throughout the week networking, okay? Which is why conferences like the one that you're running are just so fantastic, because it's so efficient to network in that type of environment when you're doing the work of bringing together hundreds of people for us. So I'm very appreciative of that, truly.
Well, we thank you for coming, and also you're going to be on stage talking specifically about some of the learnings that you've had from doing, like, there's a lot of people in this business who have been doing it maybe for 2, 3, 4 years, but you've been doing this for a while. And so we're going to have you on stage talking about sort of how to evaluate sponsors, how to evaluate opportunities. I guess tell people what you're going to be talking about while you're on stage.
Yeah, sure. So it's going to be an interesting twist, actually. I'm going to be speaking for a short period of time about helping sponsors to understand what investors are looking for when they're reviewing an opportunity, what we're vetting, and also, in other words, what things to consider from an investor's perspective that a sponsor may want to know, and how they market their deals, how they communicate with their own investor relations people, a whole bunch of stuff that some of the syndicate investors probably know, but the syndicators may not know. That's the best way to describe it.
That is perfect. Jeremy, you've been super in all of our communications, after we met just on a conference panel early in the year, super detailed, super helpful, super informative every time I've talked to you. So I really appreciate you coming on. And what is the best way, let's say, for people to maybe set up something with you, whether it's a phone call, whether it's, drinks before, after our conference? What's the best way for people to reach out to you?
Yeah, thank you for mentioning that. So the easiest way to reach me by far is my email, which is jroll, jroll, at Roll Investments, which is ROLL Investments with an S.com. So jroll at rollinvestments.com. At the conference itself, I will be there listening to all the rest of the panels, soaking up information, networking. So people will be able to track me down throughout the conference. I'll be there the whole time. But you're always welcome to email me even before the conference or after the conference, whatever's best for you.
All right. Great. Thanks a lot, Jeremy.
Thanks for having me again. I really appreciate it.